Yeah, look, well, I'm happy to go first, and then would obviously love to understand a little bit about everyone else who's on the call today.
Okay.
Well, first of all, thank you for having me this morning. Really appreciate it, both Bonnie and Mac. Appreciate you putting on this series and giving me the opportunity. So, why don't I just talk about the firm first? So, Third Prime, we're an early stage venture fund based out of New York. We do mostly seed and A round stuff. We're generalists. We like to lead deals. We like to take board seats. We tend to be pretty involved with our companies from that perspective. There's a few things that point out to you as being a little bit different about us. First it starts with the team. There's only four of us at Third Prime. All four of us have what I call non-traditional venture backgrounds. Second thing I'd point out to you, we run a pretty concentrated portfolio for being an early stage fund. If the typical early stage fund is doing 40 to 50 deals per fund, we're only doing 15 to 20. We also reserve greater than 50% of every fund's capital for follow-ons. So our strategy is really one of high conviction. We like to find folks we like early and back them through multiple rounds of growth. The third thing I'd point out to you is, even though we're based out in New York, we tend to do a lot of investing in what I call emerging regions across the United States and Canada. So almost 40% of our capital deployed has been in places like Charleston, Greensboro, Huntsville, Alabama, Richmond, Vancouver, Toronto, DC. I personally spend a lot of time in Columbus and Atlanta. One of my colleagues spends a lot of time in Austin. So it's a long way of saying, we spend a lot of time outside the major tech hubs looking for good companies. And last but not least, if you look at our website or anything else, there's no mention of social impact per se. We are certainly not an impact fund, but we do fundamentally believe that doing good is good business. And the way we think about it is, we're investors first. We're trying to make a return just like everybody else, but we do really like to back businesses where there's something about what the companies are doing just as a part of their normal course that really benefits multiple stakeholders. So I'll take a pause there. Maybe just a little bit on myself personally. I'm originally born and raised in Columbus, Ohio. So Midwest guy at heart. Went out to school at Berkeley for undergrad. After that, went down a very traditional finance path. Did a couple years of banking at Morgan Stanley, a couple years of private equity at the Carlyle Group. Worked at two different hedge funds for about 5 years before I came over to the early stage side. So I think, I spoke about differentiated backgrounds, I think, not a whole lot of VCs who necessarily have that kind of background. And I think it just kind of gives us a little bit of a different perspective, I think, when we're looking at companies.
So does everybody want to introduce themselves now? We know Mac from KettleSpace.
Yeah, I'm Mac from KettleSpace. I'm an event coordinator here. And I am in upstate New York. And yeah, just happy to keep these events going. Thanks, Sayshu. And I don't know what else to say. I'll pass it over to Esty. You want to intro yourself?
Sure. Hi, my name is Esty. I am currently in Brooklyn. I went to, I guess, my resume is that I went to school at UPenn. Then I did the Peace Corps in Paraguay. Then I worked at Amazon, had an MBA in Seattle, and then founded two small companies, a test prep company that raises money for international education that's based in Seattle, and a nonprofit in Paraguay that mobilizes children as agents of change, primarily through a literacy program called Kid Teachers. And I got back to the US in March, pre-COVID, and I'm just like looking at next steps. So I'm interested in social entrepreneurship in general, and that's what brings me here.
Cool. It's welcome back. I'm sure it's not the welcome you had hoped for, but.
Jason, you want to introduce yourself? I know you're muted right now.
I don't want to follow that. I'm in Brooklyn. Also, I'm in Williamsburg. I'm a system engineer for a gaming company, casino gaming. Been doing it for about 10 years and traveled almost all over the world. Lived in Amsterdam for 5 years with the company. And just saw this pop up this morning and thought it was interesting last time, so decided to join.
Cool.
Excuse me. Krishan left us a note in the chat. He said, hi, apologies. I will not be able to use my microphone. Background on myself, I work in the infrastructure and renewable energy space and have a personal interest in growth capital and impact philanthropic and investment given its recent trajectory. So,
Great.
Janu, do you want to unmute and introduce yourself?
Yeah, my mic may not be working properly, but I will try to be audible. My background is data science. Right now I'm doing a lot of data science. I hope you can. But before that, I've worked with a lot with finance and also some work with venture capital as well. So I'm interested in venture capital and also anything concerned with data science or AI. Thank you.
Great.
Sean, you're up. Oh, you have to unmute as well, Sean.
Hi. Okay. My name is Chand. I am the founder of a company called Enter the Box. We just completed a platform that makes RFPs simpler, fairer, and faster. Our ultimate goal is to automate the RFP cycle, generation of the first draft of the statement of work, generation of the supplier's response, and evaluation of those finally submitted proposals. But in order to do that, we needed to get data because there isn't any of this kind of data in the structured central format. So we built what is effectively a financial exchange, leveraging the background that I have in financial markets and my partner has in financial markets that includes centralized clearing of vendor administration, central structured database for public and private repositories of live and historic RFP data, and social networking, so like an instant Bloomberg function if you're familiar with that. My background is in hedge funds, and before that I made markets for 6 years in FX options before going to MIT for business school. My partner has been doing software development and software architecture for 30 years. We're both from Canada, coincidentally. We don't really have a social impact thrust that we have advertised, but we do have a social impact direction in the sense that we've been working for a while now in anticipation of completing the product on using the platform initially to help indigenously owned businesses in Canada get access to mentorship and contracting opportunities with the government, which is now accelerated by the stimulus package around infrastructure spending. And we are contemplating using the platform as well to help corporate America get deeper traction with Black-owned suppliers. So we do have a bit of a social impact orientation, but we are business first.
Great.
I think Adrian is last. Adrian Stern.
Can you guys hear me?
Yes.
Great.
Yep.
I'm also in Brooklyn. I guess a bunch of Brooklynites on this call. Huh? Yeah, my name's Adrian. I'm the co-founder of Reveal. We're building a workflow and marketplace for music creation. So one of the initial problems that we identified in the music industry is that the amount of metadata that needs to be associated to songs is really poor and often missing. And that metadata is what helps discovery. It's what helps royalty payments, etc. So we're actually building a platform that automates the capture of that metadata during the creative process, making sure that all the creators are credited properly, that the rights are attributed properly, and basically just by facilitating collaboration between content creators, we can capture all that information. So right now we're building our beta. We did a first alpha test that went really well. We're getting really good traction amongst the creator community. We've got several hundreds of producers who have signed up on our platform, and we're in touch with 20 A-list producers who have been just referring us more and more folks. So yeah, we're starting to think about fundraising, which is why I was interested in this call. Probably I guess would qualify as a pre-seed here in the U.S. But interested in having Seyshu's perspective around pre-seed, investing in today's day and age. and specifically around, what's been happening now. So yeah.
Would you like to address that issue?
Yeah,
How investing has changed? Yes.
Yeah, happy to. So look, I mean, look, it's a good question. I'm sure it's very top of mind for a lot of people. It's been interesting, right? I think, let me just answer it a bit long form here and start with just kind of the evolution of how I think we started thinking about things when COVID first broke out, and how I know other folks have thought about it too. So, back in March, I think, March and April was just full on triage mode, I think really focusing on the portfolio. I know there were headlines hitting that deals are still getting done, but I got to think a lot of that stuff was in process. I mean, everyone I spoke with was batten down the hatches, focusing on the portfolio. So, I think we've moved past that point. I think, I'll just tell you about Third Prime's book real quick. I would say the vast majority of our companies are in good shape. I think good shape in this environment is defined as folks who can have enough capital to make it through at least 2020. Certainly, revenue performance and all that stuff is varied across the deck. But I think we've certainly shifted back into looking at new deals, trying to meet people and kind of get back to normal, if you will. To answer your question a little bit more discreetly, look, I think, if we're talking about pre-seed, I actually think this is actually a pretty good time to raise a pre-seed. The reason being because the check sizes aren't too big. Pre-seed investors tend to write a lot of checks, right? They tend to write a lot of small checks. And so there's kind of a constant flow there. If you actually go back and you look at just longitudinal data on venture capital funding going back to early 2000s or mid 2000s, whatever your timeline is, you'll see that there's been this dramatic rise in the amount of venture capital funding. But if you disaggregate the data, seed and pre-seed has been like almost steady year over year and through economic cycles at about $6 to $7 billion a year. And so that's just a segment of the market that's less susceptible, I think, to these broader macro changes for somewhat obvious reasons, right? I think also it's an interesting time to be a pre-seed because, look, I think a lot of companies are going to get passes for not having great growth metrics during this time, but there's always going to be a question mark, which is, look, like, for example, I think of it this way, right? A lot of our companies are good on capital through 2020, if not through parts of 21, but at some point they're going to have to go out and raise money, right? That's the venture model. And what are folks going to evaluate them on? Well, it's easy to say, well, you'll get a pass for not having revenue, but then you don't have any revenue, right? I think as a pre-seed company, you actually are in a good position where no one expects you to have a whole lot, right? You can kind of, put your head down and just build and just build without any of that pressure. So I actually think, look, like all else being equal, I think it's actually an interesting time to be a pre-seed company. I do know, we do a little bit of pre-seed very selectively, but the pre-seed, we obviously talk to a lot of pre-seed funds who we view as partners and kind of, feeders. And they're all quite active. It actually kind of feels like they're back to business.
Yeah. Cool. Thanks.
Yeah. I'm happy to just do a Q&A here too. So, if everyone's got any questions, feel free to just kind of, throw them out there. There's nothing prepared on my end per se. And don't be shy about asking any tough questions. I'm pretty open book, so I'm happy to answer anything you guys may have.
Do we have a raising hand process?
No, just we could, but just feel free to. We do it. We're always very informal.
Okay. I'd like to hear a little bit more about your portfolio and how the companies were selected.
Yeah. So I guess portfolio breakdown first, as I mentioned at the top of the call, we're generalists. And, I would say it's probably a little bit easier to define what we don't do than it is to define what we do. So we don't do anything. So if it requires a PhD to understand the core product, we're probably not the right fit. So we don't do any biotech. We don't do any like deep robotics or like anything like that. If a group of PhDs walked to my office and said they built the deepest neural network ever, I'd probably flash them 2 thumbs up and ask them if they had any revenue to show me if anybody actually cared. Doesn't mean that those companies aren't good. It's just, we're just not equipped, I think, to do that stuff. I would say if you look at the portfolio breakdown, 40% of about a third of the portfolio is probably fintech. I think some of that's just a function of being in New York. It's a function of our backgrounds and a function of being in New York, where there's a lot of really good fintech entrepreneurs. Rather than that, I think there's, we've got companies across the spectrum: ad tech, consumer products, prop tech, human capital management software, compliance software. So there's that piece of it. In terms of how we make selections, how we think about investing, look, I think at the early stage, it's always people first, right? So I think the biggest thing that we're always looking for are, the entrepreneur. And what specifically does that mean? Look, like I think founder market fit is important, but it's not like you need to have spent, 5, 10, 15, 20 years in the markets you're in. But I think category expertise is something that we really like to see. We tend to get pretty detailed in our diligence. Not that our diligence processes are long, but we tend to try to dive deep to really understand. And, I always like to see, founders who know a lot more than I do, which is I think a good sign. The other thing is also, we're kind of seed, right? We don't do a whole lot of pre-seed. So, typically like to see a little bit of, either MVP built, it's out in the wild. You got some evidence that people are interacting with your product and using it in some way, shape, or form. And of course, look, I think, no surprise here, but I think like a lot of folks, ventures is a game of, hitting home runs at the end of the day, and I think to do that, you need, big markets, that are growing, or at least that they're big in existing fashion, and that they're going to remain that way. So TAM is important. One thing I will put in there though is that, I think we, unlike maybe a lot of traditional venture funds, will underwrite stuff, that are in smaller markets, but the valuation just has to be right. And so, I would say the formula, just taking a step back, right, is, it's team first always, then TAM, market obviously matters. Then we look at traction, and then valuation. So, probably not super novel from a high level perspective, but I hope that gives you a little bit of color.
What size checks do you generally write?
Yeah, good question. I probably should have mentioned at the beginning. So as I mentioned, we like to lead rounds. I would say the typical, check that we write is, between $1 million and $2 million leading a seed round. So, sweet spot, you can maybe call it $1.5 million. We do lead some A's. A round checks typically start 3 million plus. But we are, look, I think we have a very strong predisposition to lead. But we are flexible on check size and things like that. I think ownership is important to us, but we're flexible on check size, particularly when it comes to building out syndicates. I think we're very collaborative, and one thing I would encourage, I think all of you to think about as you're out there raising capital, I think your early stage syndicate is perhaps the most important syndicate, because those are really going to be your partners. If you pick right, I think, the folks you pick in the beginning, if you're successful and you get to a Series C and Series D, there's going to be folks tripping over themselves to give you $50 million or $100 million or whatever it is. But, the reason is because you're already successful. I think the early stage syndicate, tends to be very important.
What's the biggest difference you found from moving from investment banking to hedge funds, private equity, and now venture? Like, what is your experience of the venture market compared to those prior contexts?
Yeah. So, I think the easiest one to point out is, I think early stage venture is very people focused versus I think, banking is a bit of a different beast. It's people focused in the sense that you're talking to people, but you're oftentimes dealing with, these big companies that are doing transactions. Certainly in private equity, management matters, but you're oftentimes buying businesses that kind of, there's a baseline level of running themselves. And certainly on the public side, I think, you're oftentimes not really interacting with, you're not interacting with teams in a truly collaborative way. You're oftentimes, at least I found, interviewing them to figure out if it's a security you wanted to buy or sell. So, I think the biggest thing is that people element of it. Second thing, of course, is, at the early stage, there's not a whole lot of data to necessarily analyze. I think early stage, I think early stage investing is a lot of extrapolation, more than it is a lot of analysis per se. Although, I think there is a lot that you can analyze in terms of markets and trends and understanding, how those things are working. But, like on balance, it's certainly a less, analytical process than private equity, hedge funds, that kind of thing. And I think I would say like those are certainly the two largest differences. But one thing I'll also say though is, look, I think at the end of the day, investing is investing. I think as an investor, you're trying to ring fence risk and you're trying to price risk. And so, I don't think early stage is necessarily any different. I just think, how you think about those inputs are.
But do you think that you would have invested in deals that other more traditional venture capitalists would have passed on and vice versa? Do you have a different perspective as a consequence of this exposure to larger public companies, growth companies, companies at different stages?
Yeah, certainly. Yeah, look, the simple answer is, of course. I think we are much more willing to underwrite and look at, some companies that might have, for example, like busted cap tables. We've done a number of recaps, which, most traditional venture capital funds just won't even touch. Great companies. In fact, I think, we've got, one business that right now is marked at like a 10x, and it was a recap, and just no one would touch it. And we saw a big opportunity, and really liked the entrepreneur, and realized there was just hair on the deal that a lot of folks don't want to deal with. We've got I think we also are, I would say, attracted to that, so there's a fine line between, so if you take a step back for a second, right, there's a lot of businesses running out there that probably have somewhere between $2 and $15 million of revenue. And the difference between, and they're growing. The difference between those companies being, call it, growth equity or like small cap private equity deals and being venture deals really is just valuation, right? If a company with $2 million is tripling revenues, it's probably a venture deal. If there's a $2 million company that's doubling revenues, it could still be a venture deal, but maybe not attract the same, the same set of venture investors. And then if there's a $2 million company that's growing 50% a year, that's probably not a venture deal, right? Because people will look at that and say like, oh, that's not a whole lot of, that's not a whole lot of growth. I mean, you're at $2 million. Like if you have real product market fit, shouldn't you just be ripping? I think there's actually a real gap in that kind of that third bucket that I just talked about, because it's not juicy enough. Because a lot of traditional venture capital investors, rightly or wrongly, unless they see things ripping to the moon, they just aren't interested. And then, of course, a lot of traditional private equity guys, even small cap guys, they want to see some profitability, and that $2 million business that's growing 50% a year is still not profitable, right? Particularly if they're a tech company and they got a higher ed engineering team or whatever. But, there's a huge opportunity, I think, for those businesses to grow. And so, that's certainly an area that we look at. And, I think we actually see a lot of entrepreneurs and a lot of opportunities where we're like, great business, interesting market, this probably ring fences out to like a 5 to 10x return, which I think objectively is great for all parties involved. But, venture investors, most of them, they talk about wanting to see a path to 50x, and if that call option doesn't exist, they oftentimes are disinterested. So I don't mean to paint too broad of brushstrokes on the industry, but that's at least been my experience.
I think the corollary of the 100 to 200% growth, where they're focused on that, is sometimes that growth peters out. It's not high quality growth. It's not real product market fit, but the metrics are just a proxy for that product market fit. Whereas the 50% grower might inflect at a delayed ramp, right? So it's an interesting comment. Yeah, it's low hanging fruit.
Yeah, no, that's right. And, I think, this is where, look, I think, as lead investors, I think part of the reason we like to lead is because we like to get deep on this stuff and really understand the factors behind it, right? To your point, like there could be some early growth hacking you could do, or, maybe you're tackling what happens to be a niche industry, but the entrepreneurs do a great job of marketing it as a big opportunity, and they're just gobbling up that niche opportunity up front, right? But then they end up hitting a wall, on the back end. Yeah, there are all these different dynamics certainly at play. I think, one, you asked, the question just about like, does the late stage experience, how does it inform the early stage? I think, one of the biggest thing is, having spent most of my career really with larger, more sophisticated businesses, kind of, both folks who kind of dictate the way industries are running, and also, the intermediate players, if you will. I think you just understand that, going from like 0 to 1 is not that I'm not saying it's easy, but from a mathematical perspective, it's not that hard. Going from 1 to 2 is not that hard, but going from 2 to 100 is extremely difficult, right? And there's just so much in between, right? And folks wake up, right? I mean, I think one of the common, personal opinion here, I think one of the common misconceptions, or maybe the I'd almost call it a myth that I think is propagated in the tech community, is that, anybody who's not a tech company is this old, slow, monolithic, dumb, player that's just ready to be disrupted. And the truth is that, that's true of some players, but there's a lot of value chains where folks are fat and lazy because they can afford to be, just as an example, I'll take, fintech. I think even just 5 or 10 years ago, certainly 10 years ago, maybe even 5 years ago, the common refrain, I think, in the fintech community was like, we're going to disrupt the big banks. I think anybody who is paying attention can say like, that's just not going to happen. Right.
Right.
And the banks are fat and lazy. They certainly are, but it's because they occupy just such a powerful choke point in the value chain in the financial system that you're just not going to knock them out. You're just not going to. I mean, your best bet at this point is to create something that they want to collaborate with you on. So anyway, that was a bit of a long-winded answer, but I hope that answers your question.
No, it does. Yeah. Thank you.
We have a couple of questions in the chat. I know Krishan had a hard time with his audio, his microphone. So he's got a question. Could you expand on the purpose-driven companies in your bio?
Yep. So it's probably easier to maybe just talk about, a few of the companies, just because I think that's probably a better illustration of what purpose-driven means. So look, first thing I'll say before I dive into it is that, look, like, as I mentioned at the top of the call, we're not an impact fund, right? So what we're looking for at the end of the day are commercially viable companies, right? Like, we want to build commercially viable companies, but we like businesses, that are kind of, as I said, doing good is good business. They're helping multiple stakeholders, while they're building that commercially viable business. So the first example I bring up to you is a company called Spur. Actually, we led DA around here. It's actually a company out of Huntsville, Alabama. I don't know if any of you are familiar with Huntsville, but it's got the highest number of PhDs per capita in the country.
Yes, NASA has a big facility. They have a lot of programmers. Yes, people don't realize that.
It's perhaps the only place in the world where it's easier to find a legitimate rocket scientist than it is to find a marketer, which is actually a real problem that we've faced. The tech team is, first class, but everything else is a little bit harder to come by in Huntsville. Anyway, so what Spur does is they operate in the human capital management space. They essentially create core HR and payroll software targeting the hourly worker. Their sweet spot is they've created, fully integrated, suite of software that includes time tracking, which is very important for hourly workforces. So, where does the doing good is good, so far sounds like a normal software company. Where does the doing good is good business part come in? So Spur's vision and what they actually started off doing is, so if you take a step back, there are all these, small businesses out there that employ large amounts of hourly labor. So let's say you're a Burger King franchisee, you own 10 franchises, you've probably got a workforce of like 200 people, mostly hourly workers. So Spur basically was going to these folks and basically being like, listen, your pain point is, number one, turnover, right? These hourly workers turn over quite a bit. It's a huge administrative burden for these companies to deal with that. So they were like, look, we'll give you a suite of workforce management tools. You can manage your workforce, et cetera, et cetera, et cetera. But in return, why don't you give us your employees and we'll take them on as W-2 employees? And, I think, that's really where you see some of the uplift, right? So there's an opportunity then to offer healthcare to the workers on the platform. So Spur has about 6,000 workers on the platform. All of them have healthcare as an option. They don't all elect for it, but at least it's out there for them. They also are able to, the vision is really to be able to provide like a whole suite of financial tools. So for example, we're in the process of rolling out, our mobile financial apps, so essentially a mobile banking app. We're also in the process of rolling out Instant Pay. We're also in the process of rolling out, a couple other features that allow, these folks who are largely an underserved cohort, within the concept of financial services to really, begin to be integrated into that part of the economy. So look, that's a business where I think, I don't know how many of you are familiar with HR and payroll software, but super sticky business, extremely high margins. There's a number of public companies that have done unbelievably well in this space, and even others, in the private side who've done unbelievably well. So, I think that's a commercially viable business on its own. Oh, and by the way, our hourly workers, that's a part of the market that a lot of, the Workdays of the world, the Cisco, the Oracles of the world, the SAPs of the world, Paycoms, Paylocities, they just don't focus as much on, but because the time tracking piece is actually quite tough. from a technical perspective. And so we think that there's a huge commercial viable opportunity right there, but we really love that they're not just like creating software and pumping it out there. You know, the founder comes from like, you know, basically like Section 8 housing in Alabama, you know, is, you know, really super passionate about wanting to, you know, for the lack of a better term, really just help, you know, these hourly workers, because I think he feels like it's a bit of his background. So that's an example. Another example I'll give you is, you know, we invest in a business called Climb Credit based out of New York. So backdrop here, you know, cost of 4-year education is going like this. You know, the amount of, you know, skilled labor in the economy is, you know, technical skilled labor is going like that. So there's a real gap. Plumbers, welders, truck drivers, that kind of thing. You know, there's a lot of these folks, you know, the spur, you know, cadre, if you will, these hourly workers who would love to, you know, go get a trucking license and make a better living, or go get, you know, go to nursing school or PA school or whatever it is, coding boot camps, but they just don't have the money for it. And right now, if you want to get traditional financing, you know, if you go to Wells Fargo and you're a prime customer, they'll give you a loan to go get a truck driver's license for the tune of 25 to 30% APR, right? It's ridiculous. So Climb actually comes in, so enter Climb, right? So Climb is essentially, you know, a lead gen for lenders, but their whole sweet spot is that they've essentially integrated within schools' applications, and they've essentially negotiated such that the schools take the last risk of loss. So what that means is that, you know, the way typically loans are work is like, if you know, took out money to go to college, you know, you take out your loans and you pay, the capital you get essentially goes straight to the university. Well, in this case, what actually happens is the university only gets a portion of it up front, and they basically have a huge piece on the back end. So if the tuition is $10,000, they may only get $5,000 up front, and then that next $5,000 they only get paid back after the lender gets paid back. And the reason why that's an important mechanism is two things happen as a result. One is the rates are lower because essentially the lenders are willing to give lower rates because the school is incentivized to make sure that that their students get a proper education. And it's also relevant, number two, on that point, because, you know, I think one of the big issues with associate's degrees or kind of, you know, non-accredited, you know, education has been fraud, right? Or maybe fraud's the wrong word, but it's kind of like you get a lot of these, you know, schools that are kind of like, hey, they charge students a bunch of money. They don't necessarily train them well. They don't necessarily hook them up with true career prospects, and they essentially take these folks' money and just kind of, you know, they're kind of flagging out there in the wind, right? So this economic model, this scheme, if you will, really aligns incentives and forces the schools to make sure that they not only provide a quality education, but they also provide quality career services to make sure that job placement rates are high, because otherwise they don't get paid. So that's just, you know, a couple examples. I mean, I'm happy to talk about a few more, but don't want to just keep droning on if there are other questions out there. Yeah, and it looks like there's stuff in the chat, right? So okay, I can just take a look at this. Okay, so how much is the VC deal flow fundraising down from normal at this time, and what is the outlook? So this is from Janu. So Janu, thanks for the question. You know, deal flow itself, I don't know if it's really all that down. You know, I think, as I said, you know, in the beginning, that, you know, there was probably a month and a half where, you know, I think everyone was just kind of catching their bearings. But I think we're back to a place now where I'm still getting pinged with the number of deals. You know, fundraising itself, you know, again, you know, as a meta point, you know, this is sometimes hard to get a handle on just as an individual. You know, I saw some Crunchbase article the other day that said that funding, I think, was okay, but early stage valuations are seeing a hit. We haven't seen a hit at all. You know, I think in discussions with folks. So hard to say. I mean, look, I mean, typically, you know, so deal flow strong. As I said, you know, pre-seed fundraising still pretty good. Seed level fundraising, I think, is also holding up decently well. Look, the truth is that some of this stuff is just driven by the macro, right? And look, I think as much as we might have moved past the deepest point in the trough of what COVID has given us, there's still a lot of economic things. There's still a lot of economic ramifications that are very murky right now. We don't know what unemployment is going to look like. We don't know, if stimulus gets pulled or if Congress fails to pass another round of stimulus, what that's going to mean, right? I think we can say it's bad, but how bad, right? So, I think VCs are cognizant of this stuff, but just keep in mind that at the early stage in particular, most deals are getting done just based on dilution. And so valuations, in my mind, there's not a whole lot of room for things to move. And so then it just comes down to psychology and confidence. And as I mentioned earlier, a lot of folks just need to put capital to work. They have to invest. And so, we certainly haven't seen like some halting of processes or anything like that. I hope that answers the question. If you've got a follow-up, feel free to ask. Yeah. And then I guess Christian was asking, after returns, what are your LPs focused on at the moment? It's a bit of a mixed bag, right? I think you're right in saying returns are the most important at the end of the day. I think they're also, I guess I'll break it down to two different components. I think, what are LPs focused on in regards to how we're running things, and then how are LPs focused on in regards to, our portfolio. I'll take the portfolio first. Our LPs aren't super hands-on or demanding in terms of, what they're looking for. I think we tend to do a pretty good job with investor communications. We didn't do it this year, but because of COVID, but we tend to hold like an annual investor conference and things like that. So yeah, I think LPs are typically just like, look, we gave you money because we trust you. As long as the numbers look good, at least our LPs aren't super deep in it. In terms of what they're asking of us or how they're thinking about the GP perspective, and actually this is relevant maybe for you all to understand, because maybe understanding VC psychology and the dynamics that we face is helpful in understanding why fundraising kind of looks the way it does sometimes. Look, I think right now, a lot of LPs are probably a little frozen. What I mean by that is, again, for example, the market, let's just use the public markets as an example or as a proxy. Market tanked, then market ripped, right? And we're almost back to all-time highs. I mean, the last 3 days move notwithstanding. But that being said, there's still a lot of uncertainty out there. So the way venture works, right, is if somebody commits $1 million to our fund, we don't collect all that $1 million up front. We collect it over time and through what we call capital calls. And so right now, a lot of LPs are kind of like, hey, like, would be really not, like, obviously, if you see great deals, feel free to call the capital. But, if you can, maybe lay off a little bit on forcing me to, like, give you a bunch of money. Because the way particularly more sophisticated LPs work is, the capital that they've allocated to third prime might actually be sitting in Amazon stock right now. So they might have to go sell Amazon or go sell Delta Airlines or go sell Marriott in order to make their call. So this is a very nuanced point, but perhaps just important to throw out there, which is that, I know you all are asking about fundraising and stuff like that. I mean, this is like one of those like very like practical challenges that VCs deal with that I think startup founders will never ever see, right? Which is their discussions sometimes at committee and their discussions internally where folks are like, look, really like this, but like, is it worth, pissing off our LPs and asking them to write an additional check when we just asked them to write a check 2 months ago, and we know that like their business is hurting. For example, a big part of our LPs are high net worth individuals and family offices. These are folks who run businesses. We have several folks in our, in our investor base who are like, man, I've had to shut down restaurants, I've had to shut down hotels, I've had to shut down all this stuff, and you're about to hit me with like a $250,000 capital call right now. Like, come on, right? So, that's something that I would just point out to you guys as, there's some funds that are going to be dealing with that. Funds who have larger, more institutional bases will have less of those dynamics because larger fund of funds and things like that who allocate pension funds, et cetera, they've lived through downturns. This is their business. This is their job. They tend to, our more sophisticated investors are like, don't worry about capital calls. Like, if you need money, let us know. We budget for this. But that's what I think LPs have been focused on with us. Again, I know that's, probably a little bit different than what you might be looking for, but that might be helpful for y'all to understand that. And then Christian, I guess you're also asking what non-monetary value do you look to add to your investments? Okay, so value add. So first thing I'll say is, just reiterate, we like to lead deals. We like to take board seats, right? So we tend to be, and, we have these, what I call non-traditional backgrounds. I mean, it's really kind of legal finance type of backgrounds. We're not, the VC that's going to come in and help you build out your tech team per se. I mean, we're happy to make introductions to folks, but I think really where our value add is more strategic and board level stuff, right? So, navigating, customer contracts, navigating syndicates, navigating, projections, navigating, your financial model, your pricing model. And I don't mean that from like an Excel perspective. I mean, like actually thinking through like, well, how should you price your product? What's maybe the appropriate go to market? Hey, I'm running into this issue over here with these set of customers because of XYZ reasons. Like, how do we navigate that? We tend to be pretty hands-on where it's required. I want to be very clear about that. Some of our entrepreneurs are just like, hey, give us the ball and get out of the way. We got this, and we're more than happy to do that. And there are other entrepreneurs who want to have a call once a week, and they're folks who are pinging us, midnight, on a Tuesday. And so, I think the level of, value we add, I think is, you're asking non-monetary. And so I think a lot of it is, advice. And I think a lot of it's also, look, I think we take great pride in really supporting our entrepreneurs. I think I find myself a lot of times, it's like this job is part-time analyst, part-time investor, part-time operator, but then part-time therapist almost sometimes. I think being a founder can be a very lonely job. Even if you have co-founders, even if you're both first-time founders, it can be a bit lonely because you're kind of looking at each other and you're like, God, I hope what I'm doing is the right thing, and I think as investors, we at least, I think, see a lot of cases. And so we at least have what I'd call like data, and we can kind of normalize performance against that data where a lot of founders can't. And we spend a lot of time, I think building real human relationships. I think, as I said, we're big believers that, your early stage syndicate is the most important syndicate you're ever going to put together. Just broad brushstrokes, of course, because, our success is your success is our success. You know what I mean? There's no getting around that, I think, at the early stage. Okay. Bonnie went to go get some more coffee. Hopefully you got some. All right. So Christian, again, what are your views on the suggestions that there is bias in sourcing fundraising in the VC space, given it's usually done from networks, referrals, closed groups? All right. So I think a couple of different things there. So I guess, high level view, right, in terms of bias in sourcing and fundraising is that, look, there certainly is, right? I don't think there's any question about it. Look, I think at the end of the day, I think as early stage investors, as I said, we're oftentimes investing in people first, right? And it's a little bit like, I guess dating in a sense, if a friend is like, hey, I know this person who's really great, you should meet them, you tend to take that with a little bit more weight than if you met somebody, on a dating app, let's say, right? Not to say that the dating app can't result in something really good. So I think there's that inherent bias that exists. I think from our perspective, one of the things we recognize is that, let's just take the two largest venture ecosystems in this country are really the Valley and New York. And that those tend to be massive echo chambers. That's a big reason why a big pillar of our investing philosophy is to go to these emerging regions and to source where other people are not sourcing. So we spend a lot of time on the ground, looking for entrepreneurs, that are in very overlooked places. Again, Charleston, Greensboro, Huntsville, Alabama, Richmond, Vancouver. Toronto, I think has really picked up here, but Toronto, I think, is still very much emerging. And so, I think maybe part of the question you're asking, so that's maybe, just a descriptive answer to your question. I think part of what you might be asking is, well, how does that change, right? Or how do we change that? And I think, look, I think a big part of it, candidly, is just putting in effort, to go and do things that are different. I think, we view our sourcing in these emerging regions as certainly being differentiated. Our LPs do as well. Will that arbitrage, if you will, kind of get arbed out over time, maybe. But we're there now. And I think a lot of it is taking the effort to get to know folks, right? If you plug into communities, whether they're communities based on geography, whether they're communities based on socioeconomic status, whether they're communities based on race, I think as you start to plug in, people tend to cluster, right? Like that's just, the way humans work. And so if you make the effort, I think, to plug into certain communities, I've certainly been, surprised by the level of flow you can get, particularly if you go into some underserved places or into underserved communities. And I think the way we've dealt with it is, I think it's all about effort and just putting in the time and pounding the pavement. So again, I hope that answers the question. Happy to dive deeper if there's another question there.
I have a question about impact investors. Do they invest differently, do you think? Or are they basically the same?
So great question. So there's a term in the impact world called concessionary versus non-concessionary. And so it's very important. So I think historically, impact investors were largely concessionary. What that means is that they're willing to concede, that the folks who give impact investors money are willing to concede a return in order to see an impact. Right. And so I think that's where you get a lot of folks who are like, a little bit more like hardened financial guys who are like, oh, like, why would I take a discount? Like, I'm here to make money. I'm not here to make an impact. I think where the market is evolving to, and I think we're kind of early to mid stages of this evolution, but we're distinctly evolving to this place, is where a lot of impact folks want to be non-concessionary. So, again, as I said, we're not an impact fund, but just because we like this doing good is good business kind of concept, we've spoken to a lot of impact focused LPs, right? And I'm kind of, to some degree giving you the feedback, synthesizing the feedback I've gotten from them. And, increasingly the folks who give money to those folks are like, listen, like maybe in the past we needed a concession because people's attitudes were different, but like I think there's a growing sense that business doesn't have to be separate from what's good from society, right? Like it's not like business has to be this soul-sucking, profit-maximizing economic machine, and then some other set of bodies need to come in and help people out, if you will. Like there's a way for businesses to be set up and to do business in a way that's helpful for everybody. And I think as that concept has really gained steam, I think, folks are moving more to this non-concessionary platform, right? So for example, when we go out and market for our fund, we are extremely clear, like we are non-concessionary investors, like we are trying to build commercially viable businesses. We're trying to, like my goal is to have the highest returns, right? Of all the venture capital funds out there. I actually believe that, I think businesses that are doing good while doing good business tend to yield some of the highest returns. And it's because of a few reasons. One, I think is fundamentally, they tend to be solving, I think, real pain points. And, we all know that the best businesses are born out of solving real pain points. I think number two, those companies tend to be able to attract and retain talent better. If you're out there and you're trying to pull some, killer engineer out of Google, what's going to get them to give up a 250, 300 grand salary and take, 100 and a little bit of equity that candidly is worth nothing, right? Particularly at the early stage. You've got a small percentage of really zero. I don't care what your cap table says. It's, how do you do that? Well, it's got to be some purpose involved. There's got to be a reason that folks are getting out of bed to go and jam out code or to go think about go-to-market strategies or go build a product. So that's how we think about that.
So was there a stigma ever to having an impact investor on your cap table? Would people in later stages look at your earlier cap table and say, well, impact, because of this concessionary thing? And if so, has that dissipated?
Yeah. So if I'm to understand your question correctly, I think you're saying, like, let's just say you're at the Series A or Series B and your seed investor or your A round investor, that syndicate, or maybe even the lead was an impact investor that hurt you. Look, I think the answer is this, is that I think at every milestone, so I tend to think of these things as just milestones, right? So venture is a game of milestones, right? You're going from milestone to milestone to milestone. So at each one of these milestones, you will be evaluated primarily, I think, on two things. One, you'll be primarily evaluated on yourself. and then, or the founding team, as a whole, and then you'll be evaluated on your metrics, right? And I think as you get older and older, as you kind of get bigger and bigger, there'll be more and more metrics to look at. So basically, if you're at the Series A or the Series B and your metrics are killing it, right? Like you're doing a great job, you've got great growth or retention, or cohorts, whatever the business is that you're in, I think folks aren't going to look at the fact that there's an impact investor in there and say anything, because they're going to see a commercial viable opportunity that's blossoming in front of them, right? I think if your metrics aren't fantastic, then I think that's what I think sows doubt. I don't think it's necessarily seeing an impact investor. In fact, I'll just give you a bit of a counterexample. So with Climb, for example, Climb has had a bit of a long history. They've actually been around for like 4 or 5 years. They actually raised, I don't know, 20, 25 million bucks before we ever got involved. And, we're this like very hot, like fintech story. And then, the actual traction didn't meet that promise. And so long story short, this is actually another example of where we recapped it, where our backgrounds, I think our differentiated backgrounds, no one else would touch it. We did, and so, this is an example where once we let it, right, they couldn't find a lead to save themselves, like they couldn't. And so we were like, look, we're happy to do this. We'll come in, we'll price it. We'll clean up all the legal stuff. We'll clean up the capital. We'll do everything. Right. And once we did that, we actually had like 2 or 3 different impact funds that I don't want to say they came out of the woodwork, but they were like, wait, we really loved everything about what they were doing. It's just, we don't do that kind of work. And so we'd love to be in. And we were actually more than happy to have them in, because we think particularly for a company like Climb, it's great branding to have some of these, brand name impact funds be a part of it, because it at least shows that that's like a stamp of approval in terms of what they're doing as a business.
See if we have any more questions in here.
Yeah.
And Michael, I see you, and you're muted right now, and you got here late, but if you'd like to introduce yourself, please feel free.
Absolutely, sorry about that. Michael Khait, I'm with Khait Ventures Group. We are a management consulting company operating in defense space. We actually managing exclusively Starbucks franchise on U.S. Army and Air Force bases in Europe presently.
Got it.
Where are you at the moment? Where are you based physically at the moment?
I'm actually in Florida for 2 weeks. I'm usually based in between London and New York City.
Oh, okay. So do you have any questions for our investor?
Actually, it was I really loved some of the answers, and it was really very informational for us.
Great. I'm happy it was helpful.
Thank you. Very honest answers as well. It really kind of shed the light on the whole other side of it, what's going on in the VCs, and that was very, very helpful in understanding a lot of the dynamics that we've seen. We are currently actually doing the Reg A Plus offering that should be launched by the end of August, and that was a pretty difficult decision which route to go as well, and we saw a lot of the dynamics that you described talking to the investors.
Yeah, that's great. Well, good luck with that.
Thank you.
Yeah. I think Christian, at Chand, I guess, yeah, there's also sustainable capital funds and investment teams side to ESG, UN sustainable goals in between, impact and traditional investing. Yeah. So, all right, great. Yeah. It doesn't look like there's any more questions in the chat, but, happy to, to answer anything else. And, I know a few people have got to get going. I mean, please don't feel bad if you guys have to move on and go do things.
Can I jump in with the last question?
Please, yeah.
Do you have any tips on the best ways to, network during this time? As a first-time founder, I find it, quite challenging to grow that investor network, especially now that I can't, show up to conferences or talks or whatever. So any tips around growing the investor network, in a remote environment would be awesome.
Yeah. Look, it's a great question. I don't know if I have a silver bullet here. Look, I think some of the stuff that I think was working before is still probably applicable now. So for example, I get hit up on LinkedIn a lot. Do I respond to everything? I mean, I typically try to at least say like, no, thank you, when I'm not interested. But am I hopping on calls with everybody? It's just only so many hours in a day, right? So that's tough. But look, I still think there's something there. Look, at the end of the day, right, this goes back to some of the bias in the networks question I think that was asked earlier. Look, humans tend to react better. It's a psychological point, right? Humans tend to react better when they get warm intros, right? So the best thing you can do always, whether it's COVID or not COVID, is just you find somebody who you can build a relationship with, and then kind of gently, politely, or if you get to know them really well, kind of very openly ask them if they can introduce you, right? And some of those things become trickles. And I think if you're doing I think reality here is like, if you're doing a good job with that, like I think that network will build itself. I think one thing, so I know that's not necessarily like a great, I don't know how helpful that answer is per se, but I also, look, this is something we struggle with too right now, because we're like, how do we meet entrepreneurs? How do we meet prospective LPs, right? I mean, we're dealing with similar dynamics. One thing I'll say as an aside is that, look, I've gotten ultra comfortable on Zoom. I mean, to the point where like certain conversations I'd almost rather have over Zoom than in person. I think certainly when you're meeting entrepreneurs, it's better to meet them in person than over Zoom. But a number of other meetings and stuff. I mean, I think on the back end of this, we'll certainly, I'll at least certainly, be looking forward to doing this more. So, so that's a bit of an aside. What I was going to say though is I think your question really, I guess, made me think of something a little bit tangential, which is that, look, I think one of the things that founders don't often do well enough, and they don't realize well enough at the beginning, is they view fundraising as a chore. And it sucks. I get it, right? Like, look, we fundraise too. And it's we like to we joined this business to be investors, not to be fundraisers, right? But I think it's really important to understand that if you want to build a venture scale business, you are going to be fundraising a lot, right? And, the advice I always give entrepreneurs is get used to that, embrace it. You know what I mean? It's kind of like, just to draw like, maybe like a sports analogy, it's like, if you want to be, top of your craft, basketball, football, soccer, it doesn't matter what it is, like you got to embrace running like wind sprints when no one's looking. That's kind of like the type of attitude you got to have when it comes to fundraising. And so I think it's a good question around networking. And I would just expand it to say, like, always be networking, because you just never know the investors, who are going to convert for you. You never know when they're going to make that connection for you that's going to work. I mean, candidly, I think the CEOs, the founders who raise the most amount of venture money, note that I'm not saying the best founders, note that I'm saying the venture founders who can raise the most amount of money, they're basically two, I think, qualities I've noticed. One, they're incredible at spinning stories, right? They're incredible at painting stories and painting, like basically painting a visual with their words, and then maybe with a deck or whatever. And number two, they are like incredibly good at networking with investors.
That's true. And there are a lot of investors, like I do the weekly newsletter, and I've been getting like lists about for the last few weeks about an Airtable list, investors generally who are actively looking to invest. And most recently, the New York City investors, early stage, who are looking to invest. And one of them, it's like over 300 firms now.
Yeah.
I'll tell you the vertical too. They might not give you their contact information. That's where you have to get out there and network, and that's your job.
Yeah. Yeah. Look, I think like anything else, it's interesting dynamic, right? Because capital is cheap, right? I mean, there's just so much money out there, right? There's literally just money sloshing around out there, but it doesn't always feel that way if you don't know anybody with a bunch of dough, right? And so you gotta, you just gotta tap into it. I mean, look, as I said, we face a very similar challenge when it comes to fundraising. We know there's a lot of money out there for venture capital funds, right? But how much money is there for third prime? Well, that's really a function, I think, of our ability to go and go and get it.
So I have a question for you. Since you do invest in secondary markets, and we're seeing this great abandoning
migration, yeah,
of urban centers. I hear people are leaving New York, and they have no intention of going back. And everybody's used to Zoom and working remotely, and that doesn't seem to be a problem. Do you see secondary markets emerging in various regions that we might not have noticed before?
Sorry, say that again, Bonnie.
In regions that we might not have noticed before?
Yeah, look, I think, look, I'll tell you. So I'm very bullish, like Atlanta. I'm very bullish. I mean, Austin is like, old hat now. I think everyone's kind of on that train. But like, I'm bullish, for example, Columbus, Ohio. I'm bullish Nashville for certain sectors. So yeah. Look, I think the backdrop from an investment thesis perspective is that, I believe that, so for a long time, tech has been viewed as an independent pillar in our economy, right? So it's like there's retail, there's industrials, there's energy, there's healthcare, and then there's tech. And I think increasingly, as tech has gone from a pillar to really going horizontal across all pillars of the economy, right? Like the next generation of businesses, some will be pure tech companies, but many are going to be tech-enabled companies, right? And I think to build those tech-enabled companies, you're going to need more than just, a PhD from Stanford or MIT or whatever it is. You're going to need folks who really understand those businesses. And so that the business know-how, the real business knowledge. And we think that, that those are going to come from places where the analog versions of those businesses exist. I think that, so that's been the backdrop of like, our thesis. I think that COVID is certainly going to, accelerate that trend to some degree for sure. I don't think it's going to be like night and day, right? I don't think we're going to wake up in 2021 and the pendulum is going to have shifted super quickly. But I mean, look, I'll just take Columbus as an example because I'm born and raised here. 30 years ago, I don't think Columbus knew what software was. I mean, I don't mean to, be disparaging here, but like, it's, I grew up in a community where like no one talked about tech. You know what I mean? Like, obviously, like, my parents invested in like the .com bubble and stuff like that. But like most of what I heard was like how they lost money in Microsoft and Cisco and Yahoo, not in like, how technology could really change the way like the world worked. It's very different than the Valley in that regard. I think fast forward to today, and there's an incredibly vibrant ecosystem out here. It's still very nascent, but it's incredibly vibrant. I think, you think about structural, what I tend to look for when we think about cities to canvas is like, you want to look, it's just like investing, right? You want to look for like structural assets, right? So for example, Columbus is 14th largest city in the United States. It's home to 6 Fortune 500 companies. We're within driving distance of, I think like 15 universities, like 3.5 hour driving distance of 15 to 20 universities. So you've got a really deep pool, including 2 mega universities in Ohio State, which is based in Columbus, and Michigan, which is in Ann Arbor. So you basically have access and talent to deep pool of talent. There's migrational patterns that are benefiting a place like Columbus. So for example, Ohio, if you guys aren't familiar, is a lot of farmland. As farming and manufacturing, as farming and small scale manufacturing has left this country and has kind of consolidated and died, if you will, like there's been a massive migration pattern. So there's a lot of bodies that are coming to Columbus. And so I think these things are only going to be accelerated. I know folks who, maybe 10, 15 years ago, family, friends, they would have been the type of people who are going to leave Columbus and go to Chicago or a New York. And now they're like, I don't know, life in Columbus is pretty good. We've got better restaurants, we've got better bars, we've got better nightlife, we've got, better housing is being built, meaning like more modern stuff. Like, there's a lot of that stuff going on. So I am bullish. I do think we'll see that trend. I think you phrased the initial question as like, will we see a rise in these places that we hadn't seen before? I think if you were paying attention before COVID, I don't think it's going to shock you. I think if you weren't paying attention before COVID, I think you'll probably be surprised by some of the traction over the next few years.
That's just because Steve Case was focused there with his Rise of the Rest too.
Absolutely. Yeah. Or even like Drive Capital, right? I mean, look, I think it's incredible. I think it's incredibly powerful that 2 former Sequoia partners decided to set up shop in Columbus, right? Like, it tells you a lot. They could have chosen anywhere, right? Why Columbus? So, just to be clear, Drive actually doesn't invest almost at all in Columbus. I mean, almost all their deals are outside it. The only deals they've done in Columbus are deals where they convince the teams to move to Columbus. It's a dirty little secret, but it still says something that like they decided to move here. And obviously venture is a long-term game, right? Like we're trying to predict things 5-10 years, if not longer, into the future. So I think the trajectory is pointed up as a trend line.
So does anybody else have any other questions? I was wondering if you want to share your contact information with the group.
Yeah. How do you should I just throw it in the chat, or do you want to email folks? What do you?
We can just throw it in the chat.
Yeah, I'll just throw it in the chat. I'll just throw my email in the chat. How about that? Yeah, look, I'll say this just, I guess, as a closing comment. Look, I know, as investors, we meet with a lot of founders. We see a lot of startups. It's our job. But we're fully appreciative that our job is challenging, but fully appreciative that as entrepreneurs, your job is the most challenging. I think I'm always amazed, because it's like, we're investing capital, which is something we can, in essence, touch and feel. Our founders all of you really are really creating something out of the ether. It's like you're waving your hand, and if you wave it just right and you kind of get the right things around you, then suddenly something starts to appear out of nothing. And I'm always amazed by that. So I think the early stage, I think in many ways, look, I think every stage is challenging, but the early stage in many ways can be the most challenging. And so if we can ever be helpful, please let me know. Happy to be a resource. Look, I think the environment out there feels very uncertain. I think that's because it is, eyes wide open on that. But look, I think particularly at the early stage, if you're a pre-seed company or in a seed stage business, I think this is a great opportunity for you to just put head down, build product, and really address, I think pain points. I think it's, if the biggest thing I always talk to our companies about, and even when I meet prospective investments, the number one question I always ask is like, what is the pain point you're solving? Because it's well documented that the best companies arise from solving the biggest pain points.
Yep, that's true.
Great.
So anybody else? Thank you so much.
Yeah, of course, Bonnie. Thank you for having me, and thank you to everyone for having me as well. I really appreciate the opportunity.
We appreciate you taking the time to chat with the group too. Thank you.
Yeah, happy to do it. Well, good luck, everyone, and hopefully we get a chance to chat again soon.
Okay, thank you.
Thank you. Bye.